CNBC TV 18 special as we count down to the Union Budget 2023. I'm Shireen Bhan. Through the morning, we've been breaking stories on what the economic survey ahead of the budget is likely to say as far as the macros are concerned. Very quickly, for the benefit of our viewers as well as our guests who are joining us, Upasna Bhardwaj of Kotak Mahindra Bank, Pranjul Bhandari of HSBC and Kaushik, the Chief Economist of Deutsche Bank. They'll be with us, and of course Lata here as well. A quick summation of what our team of reporters has been able to gather on what the economic survey is likely to throw up. As far as growth is concerned, 7% for the current fiscal, that is what the survey is going with as well. And as far as the future goes, the survey is projecting a baseline GDP growth of 11% in nominal terms and 6.5% in real terms. That is for FY24. As we point out, this is largely in line with what the IMF, the World Bank, etc. are projecting. When we talk about further accelerants to growth, the survey is pointing out that the economy is expected to continue to grow briskly in FY24 on the back of a further expansion of the digital platforms, of the public digital platforms to be specific. Initiatives like the Prime Minister Gati Shakti, the PM Gati Shakti program, which has already been announced and is currently work in progress, as well as the National Logistics Policy and PLI schemes. The question now is, are we likely to see more PLI schemes being unveiled in Budget 2024? The expectation is that as far as high employment generating sectors like toys, etc., are concerned, we could see the government move that in that direction. On some of the risks that the survey is highlighting, specifically as far as the current account is concerned, it says that on the external front, risks to the current account balance stem from multiple sources. What we are given to understand is that the survey talks about two silver linings on account of the slowdown in global growth for India. One, of course, is oil prices coming off and coming off sharply and hopefully staying there. And the survey expects that the current account deficit will be better than is currently projected. The overall economic situation will remain manageable. The survey also talks about what has happened as far as the rollout of the ECLGS schemes, etc. are concerned. It talks about incipient signs of private capital formation as well. So sum and substance, that's in a nutshell what the survey is highlighting. We don't know if there are going to be any big ideas that Anant Nageshwaran's first economic survey throws up. So far, it seems like he is going to give an assessment of the year gone by and, more importantly, what he expects the macros to look like. Let me bring in our guests. Pranjul, to you first. In terms of the growth estimates that the survey is likely to hold out, your first take.
Yeah, Shireen, you mentioned 6.5% growth next year, FY24. My sense is that's a little too high. I would have been more comfortable with, 5.5% real growth and a nominal GDP growth of 10. And they've sort of come out with 11 as per your comments. Now, the reason I think it should be a little lower, threefold. One is exports around the world are slowing. Day by day, we are seeing more and more data that shows that industrial activity, trade flows around the world are slowing. And that is going to, take a toll on India's GDP growth. The second is our own domestic pent-up demand is now fading a little bit. If you look at financial savings with households, they've fallen back to pre-pandemic levels. And finally, if the budget really wants to bring down the fiscal deficit by about 60 to 70 basis points, that's actually negative for growth. It's great for macro stability, but it's a bit negative for growth in the short run. So for all of these reasons, I would have preferred a slightly softer GDP growth estimate for FY24. Quickly, just take one more minute. Rightly mentioned about the public digital infrastructure, the PLI scheme, and I'm a big fan of both, but I think their benefits will accrue over the medium term. Good point on central government capex. It has been huge, but the problem is to the extent the central government is increasing capex, the states are cutting down their capex. So they're offsetting all the efforts the central government is making, at least, currently. So, these are some of sort of like the negatives we need to keep in our mind, and I would have preferred a slightly lower growth estimate.
A slightly lower growth estimate is what Pranjul was expecting, but 6.5% is what we are given to understand that the survey is going with. But point taken on the export front, Pranjul. In fact, the survey also talks about the fact that there is likely to be a plateauing of exports on account of slackening global demand. Upasna, let me come to you first on the growth numbers as well as some of the risks that the survey highlights, especially on the current account.
Absolutely. Shireen, I would tend to agree with Pranjul. We are at 5.6% real GDP growth for next year. And alongside, we're at 9.5% nominal GDP growth. Clearly, some of the factors which Pranjul has highlighted do remain a point of worry. Apart from exports, I think consumption is something which I remain quite worried on the domestic side, largely because the urban consumption, which was largely led by the catch-up, which the services sector and all was playing up. Now that is really, tapering off, and that impact is fading off, and we don't really expect that to sustain into next year. Alongside, of course, the second round impact of the government spending that could have come, that will be restricted because of the expected fiscal consolidation that they would have to maintain going ahead. So all of these factors do tend to weigh on overall economic outlook, and hence a sub 6% real GDP growth looks more likely and realistic. And hence, of course, the government's numbers look a little optimistic. Alongside the risk that, the economic survey probably highlights, clearly there are two sides of this. One is, at the moment, the silver lining is that, the global growth slowdown is likely to keep commodity prices slightly on the softer side, which should be positive for India because oil prices will be in check. But at the same time, there is an uncertainty with respect to China's recovery and how that's really going to impact overall commodity cycle. Yeah. So I think there is a fair amount of risk. At the same time, the fact that, the domestic economy is expected to grow faster than the rest of the world, the current account deficit pressures will remain, even though they will be better than last year, FY23. But nonetheless, those risks will remain, and we'll have to be watchful on the external sector.
Yeah. And that is exactly, Upasna, what the survey, as per sources, is also highlighting, that is something that we need to be mindful and watchful of. But Kaushik, your growth estimates and the Finance Minister tabling the economic survey, let's just listen and then I'll come back to you.
2022-23 highlights and economic survey 22-23 statistical appendix.
आइटम नंबर 4 श्री पंकज चौधरी जी।
अध्यक्ष महोदय, मैं संविधान के अनुच्छेद 151(1) के अधीन निम्नलिखित पत्रों की एक प्रति अंग्रेजी तथा हिंदी संस्करण आपकी अनुमति से सदन के पटल पर रखता हूं।
It is now official. The economic survey has been tabled in Parliament, and we've been bringing you details and highlights of what the economic survey has projected in terms of growth, as well as growth accelerants and some of the risks. Kaushik, to you, growth numbers, and just again for the benefit of our viewers, entrenched inflation may prolong the tightening cycle, and therefore borrowing costs may stay higher for longer. This is again one of the risk factors that the survey is highlighting. Kaushik.
Yeah, hi Shireen. 6.5%, is a little on the higher side. We have a forecast of 6%. Market economists tend to be more conservative, so we are working with 6% with downside risk towards 5.5%. If you remember, the last economic survey also came out with a forecast of around 8% for FY23, but then we had the Russia-Ukraine war, and for that, we are probably going to get 7% or slightly below 7% in this year. So it's kind of, good to start with a conservative estimate, and then if you have a positive surprise, nothing like it. So we are working with 6%. The point that you made, the last point, I think Pranjul spoke about the risk. The one risk that I'd like to add on to that is the fact that RBI has hiked interest rates quite aggressively. Within a very short period of time, interest rates have gone up by almost 300 basis points. In February, there could be one more rate hike. And the problem is that unless the US Federal Reserve is ready to cut rates, which will take a long time, RBI probably will not be able to cut interest rates, and therefore you'll have policy rate remaining sticky at around say 650 for a long time. So that will not give support to economy, and we know global growth will slow down, so Indian economy will slow down. So I'm expecting fiscal to give some support to growth, and that's why we're expecting fiscal deficit to be lower to 6%, not below that for FY24, which would probably give some stimulus to growth, when global growth is going to slow down.
Well, I just want to point out that the numbers now are official, flashing on your screens, but you heard it first here on CNBC TV 18. The CNBC TV 18 news break stands confirmed. Let me bring Lata in. Lata, sum up for us what you make of the numbers, and of course, we will get more details as we pour over the fine print.
Yeah, I did a quick poll as soon as the numbers came out. I mean, as soon as our sourced numbers came out. And the market is with what our three economists told us. The average I'm getting is actually 5.8 for real GDP, and 10% for nominal GDP. That's what the street is going with. If I take out the extreme ones, because there's one reading of Nomura with only 5.1% real GDP expectation, even then the market expectation is 5.9. So it is sub 6. And the survey is going with 6.5 with a range of 6 to 6.8. So they don't have, even in their worst case scenario, a sub 6 number, but the market seems to believe that is the average. The nominal GDP has come in at 10, and of course, as we know, the survey is standing at 11. This is not going to harm the market. I mean, after all, for the past half hour, we have broken those numbers, and it's not as if the bond market is terribly disturbed. Are you expecting a 303 trillion GDP number or a 301 trillion GDP number is the difference? And I don't think that really disturbs the fiscal deficit number. Suppose you have 5.9% of 303. Even then, the fiscal deficit number is 17.8, 17.9. The market is sitting at 17.5. So I think at the moment, the bond market is not disturbed, even if there is a slight degree of optimism. I would still just worry a little if they assume that nominal GDP is 11% and therefore tax growth is 12%, expecting a 1.1 buoyancy, then there may be a charge of overestimation. Again, market is not yet worried. Bond markets are not reacting. I just want to point out, Anand Nageshwaran has written in the Mint today, and he says, the survey always takes off on the nominal GDP estimate and ignores everything else. So we shouldn't perhaps harp too much. He says these are conditional estimates after all. They did not know last year that the war would break out on February 24th when they were presenting the survey. Yeah. We don't know what we are in for. So that's his defense. But back to you. Anything more? Prashant? No, go ahead, Shri.
No, absolutely. No, you're right, Lata, in pointing that out, because, the survey's estimates, of course, were completely different from what it finally turned out to be, largely on account of what we saw happen on account of the war. And so that caveat is well taken. But again, to get our commentators back in on what the survey is suggesting, of course, the government capex continues to be the big driver of growth, but incipient signs of private capital formation. Pranjul Bhandari, that is what the survey speaks of, and also obviously bets on to get to that 6.5% number.
Yes, Shireen, that's sort of something we're seeing as well. Through the pandemic, we've seen the formal sector becoming larger, the big firms becoming bigger, and these firms have gained in profitability, have gained in market share, and today we see investment intentions from them actually rising. So I think there are good prospects for investment to rise in the medium term. Of course, balance sheets have also become far more supportive, less debt in corporate balance sheets, lower non-performing loans at banks. So I think there is a very nice sort of ecosystem that is coming together. The only problem right now is twofold. One is there's still a lot of global uncertainty, and generally private capex doesn't flourish at a time when oil prices are volatile, when inflation is volatile, when there's sort of opaque growth outlook around the world. I think we really need the global macro environment to stabilize before India's private capex truly takes off. And my second problem, which I mentioned earlier, is the fact that the central government is doing a lot of very good capex, and it's very exciting. But unfortunately, the states are not. In fact, they are cutting back on capex as much as the central government is pushing into capex. So they're really offsetting all the efforts there. So look, generally speaking, I'm positive. I think there's good things happening, but it won't be immediate that, private capex really takes off. We'll have to be a little more patient.
Okay. Thanks for that, Pranjul. Let me take off on that point on private capex. I think it's very positive that the survey is not kind of drumming up that capex has picked up. It's making a very tentative statement that there are incipient signs. I think that's a sign of realism, rather than to believe it has arrived and say that we're only seeing first signs. Actually, it's concentrating on the fact that, the government is raised capex is compensating for the private sector's caution. So very much, on the lines that Pranjul is saying. But Prashant, on this point, I'm, government itself is finding it difficult to spend. Pranjul is making the point that the states are not spending enough. But even the centre is not spending enough. They could not find enough projects. That is why they have given 1 trillion rupees as interest-free loans to the states. And even in the centre's own capex, they have taken 65,000 crore of the NHAI projects, which were already there. they were not fresh capex. So even to reach that 25% higher capex, the government had to assume the NHAI's projects and had to give 1 trillion to the states. It's not very easy even to spend. Identify projects, get the land acquisition going, get all the permissions going. So anyway, your thoughts, on what you've heard so far.
The first comment that you made, I think that perfectly captured, Lata, what you said. I mean, I think the years of obsessing over the 0.4, 0.3 fiscal deficit, I mean, that is long gone, right? I think the last 2 or 3 years of shocks to just the Indian economy and the global environment, I think it's now slightly more bigger picture rather than, very precise numbers, unless and until, of course, estimates, as Pranjul pointed out, are very outlandish or anything of that sort. So these are largely in line. I mean, I was going through, while preparing for, of course, tomorrow's big event, going through the numbers, and these may be slightly aggressive on the nominal side, slightly more aggressive on the real side, but they're not in any way very, very outlandish or anything of that sort. I think what we'll wait for is, of course, more from the economic survey now that the document has been tabled, and figure out what else is of interest, what can give us further cues in terms of the direction that the government really wants to take. I don't know if I can ask, Upasna is still with us, Pranjul is with us, Kaushik is with us as well. Shireen, sorry, you want to come in?
No, I just wanted to mention that in a departure from previous economic surveys, Prashant, this economic survey has a chapter on India's social sector, followed by a chapter on climate change and environment and social welfare as well. So there's 3 chapters that the economic survey that Anantha Nageshwaran has authored, a departure from the past. So social sector, environment and climate change also getting a mention as far as the survey is concerned. We'll of course go over those chapters, but a mention also coming into the way that the markets performed in 2021 and 2022. The survey says the last 2 years have seen a big rise in the participation of Indian domestic retail investors in Indian stocks. Not only did their investments cushion the impact of portfolio outflows that occur from time to time, but they also added to their wealth stock given the performance of Indian stocks in 2021 and 2022. Prashant.
No, absolutely, Shireen. I think it would be completely impossible to ignore, because that has been the one big phenomenon in terms of financialization of the general public out there and the amount of money that they've poured into financial assets, stocks more specifically. Upasna, in terms of we'll of course keep putting out more and more in terms of details. Shireen mentioned these new areas which find a mention in the survey. But in terms of looking for directions, what else would you look out for from the survey? What would be top of mind for you?
No, I think there are 2-3 things I would look out for. One is, of course, the focus on the MSME sector. I think the challenges which the MSME sector has faced through the course of last few years, they're still not out of the woods, and their financing needs really have to be restored very well. Of course, the ECLGS program and all has helped clearly, but more needs to be done, especially when the export sector or export demand is expected to fade off further. And almost 45% of the overall exports comprises from MSME sector. So I think in this context, I am looking for some more support and guidance for the MSME sector. And secondly, which is probably linked as well here, is the employment opportunities. This is more, again, from a medium-term point of view. And since economic survey often tends to also talk about a medium-term strategy of growth, I think that is where I would want to look at in detail what would be the employment opportunities which will be generated for the lower segment of the economy. Because I think the formalization has, of course, happened, but there is still a kind of a K-shaped recovery that has happened, and the bottom of the rung still needs to be lifted off. So I think there I would want to see a much more clearer view on how the employment environment is expected to pan out.
Okay. Well, we have the survey with us, holding it in my hand now. And I'm just turning out to the Outlook paragraph. First chapter has an Outlook 23-24 paragraph where they point out that budgeted capital expenditure has risen to 2.7% in the last 7 years, that is from FY16 to FY23, and before that it was in the lower 2%. So that is genuinely a big reinvigorating of the capex cycle. Structural reforms such as the introduction of GST and IBC has a bankruptcy code has enhanced the efficiency and transparency, ensured fiscal discipline and better compliance. Global growth is forecast to slow down. So that is the challenge they point out. Global growth forecast to slow down from 3.2% in 22 to 2.7%. So a good half a percentage point slower growth in the IMF's outlook. A slower growth in economic output coupled with uncertainty will dampen trade. This is seen in the lower forecast for global trade as well. So these are the dangers that they are pointing to. The upsides to India's growth outlook rises from limited health and economic fallout for the rest of the world from the latest round of COVID-19 infections in China, to the inflationary impulses from the reopening of China's economy turning out to be not very significant, not very persistent. So China's recovery is, they're not saying disinflationary, but certainly not inflationary. Recessionary tendencies in the major advanced economies triggering a stopping of monetary tightening, return of capital flows to India. That is one of the hopes, one of the positives they are expecting. And all this leading to an improvement in the animal spirits and providing further impetus to private sector investment. These are the positives, the upsides to the growth outlook. Would you agree, Kaushik Das?
Yeah, Lata, most of the points, it makes a lot of sense. One point I want to make, government has done a lot, the central government, as far as pushing capex is concerned. But if you look at the numbers, out of total investment in India, 75% share is private capex, private corporate sector, and 25% is public sector. So that 25% has been growing pretty, strong year after year, and whatever budget space is there, the central government has pushed. But now it is time for the private sector to chip in. For the last 10 years, they have not invested much because of deleverage issues, and 2020-21, we had the COVID. Now from 22, we have seen capacity utilization increasing, and that gives, and profitability has also increased to some extent. So that gives some, incentive for private corporate sector to start investing. So if that 75% share starts moving in the right direction, even incrementally, we don't expect that any particular year you'll have a free runway, that you'll not have any kind of global problem. Something or the other will happen. But you can't wait forever not to invest. And if that happens with a 5-year, outlook, that corporate sector decides for the next 5 years, things are looking, okay, the banks do not have a balance sheet issue, the bankruptcy code is in place. So the ecosystem to invest is pretty good. And from now till 2030, if we take a big view, that itself can lead to, 6.5% growth over, the next 4-5 years. That's why we are a little bit more optimistic in our growth forecast of 6% for FY24 compared to markets being slightly lower. And the fact that China reopening is happening, China's growth forecast has been revised up, which in a way can be positive because of the trade linkages, and therefore you could not kind of see the amount of slowdown that we are fearing, later last year.
Okay, got that. Yes, perhaps Indian industry will wait. India Inc. will wait and then, work with the uncertainties to invest more. Before I toss to you, Shireen, I just want to congratulate you or whoever it is in the team who got this scoop damn right. You know what is the outlook sentence saying? Entrenched inflation may prolong the tightening cycle, and therefore borrowing costs may stay higher for longer. Wasn't that the very sentence you broke?
Higher for longer.
Yes.
I remember. Exactly. I remember it by heart now, Lata. I've said it so often since this morning, but it is teamwork. Our reporters have been out there, Sapna, Timsy and Parikshit, bringing our viewers the highlights of the survey before it was tabled in Parliament. But, just again, to the point that that we were all making, I mean, I find it quite impressive that the survey's headline for its first chapter very unequivocally says, Lata, that the recovery is now complete. The recovery that we saw in 22-23 is now complete. And of course, many aspects given there on account of the ECLGS and what the government did in terms of spending and so on and so forth, also making a case for the unemployment number coming off sharply between September of 21 quarter ending September 21 to currently from 9.8% to 7.2%. But that headline, the chapter headline, Shireen, the recovery is now complete. Yes,
Lata. That point is taken. But, we have recovered from COVID. Recovery complete. all the more reason why you cannot manage a 6% fiscal deficit. Fiscal deficit of 6% plus 3% states is justified for a maimed economy. If you yourself are admitting it is a recovered economy, then there is a responsibility not to have a loose fiscal policy, isn't it? I mean, I think that would be something that the market will watch out for. Upasna, do you think that's the next big number to watch out for, fiscal deficit?
Absolutely, Lada. I think there are two parts to this. One is, of course, the coming year's fiscal deficit, and the other is however much aggressive they get this year, that will set the tone for their medium-term roadmap that they have set for achieving 4.5% by FY26. And I think that is very crucial from a medium-term perspective to anchor inflationary expectations, because, monetary tightening, there's a limit to which they can manage inflation. There has to be adequate coordinated fiscal consolidation alongside to manage inflation expectations. And so to that extent, markets would be watching out for how much aggressive fiscal consolidation. But more than just the fiscal deficit ratio, for markets, it is the gross borrowing number eventually that matters. And that is where the assumptions on other sources of financing, particularly the small saving collections, that will matter a lot. So whether it is going to be a 15 lakh crore or a 15.
Well, we seem to have lost Upasna there, but we will, of course, re-establish that connect with her. Once again, just going back to what we've, of course, been reporting, what the survey now does put out as official headlines. It talks about, of course, the rise in interest rates and entrenched inflation as the key risks. So, Lata, let me toss that across to you. Given what we have seen the survey say, what's the expectation now for the first week of Feb?
I'm getting a sense that there is a little bit of optimism in the survey. The 11%, growth forecast, I do hope that we don't go overestimation. That is not the DNA of the CEA. Last time they clearly underestimated growth, underestimated tax buoyancy. I hope that conservatism continues. At the moment, it looks like a little cheerful. Let's hope good cheer prevails. But if we are more cheerful than the year turns out to be, I would be a little worried. The survey looks a bit too cheerful, at least the first few words. But maybe I should toss that to Pranjul. Pranjul, from what you have heard, do you think the optimism is well placed, or do you think the optimism is a little worrying?
We don't have enough, and we'll have to wait tomorrow, because there are going to be a lot of other parts of the budget. What the assumption on tax buoyancy, there is assumption on privatization receipts, which will give us a full picture. But for now, you're right. I agree with you that 6.5% GDP growth looks positive. In fact, as you said, if the pandemic recovery is complete, actually that is a problem for growth. We are very happy that urban employment is good, but all of 2022, all of these workers who had gone back to rural India came back to urban India. Whenever an average person comes back to urban India, he earns and spends 2.5 times more. But that entire readjustment is now complete. We don't have that growth push coming from urban readjustment in 2023, in 2024. So, that source of growth is going to go away. So from my perspective, I do think that this number of 6.5 is actually a little negative. I agree with his assessment that the global condition is keeping growth weak. But I think there's also a domestic point to it. The fact that pent-up domestic demand is now coming to an end. We're already seeing financial sector savings of households have dipped below pre-pandemic levels. They've gone out, they've spent, they've had that extra holiday. They don't have too much extra firepower to spend in 2023 and 2024.
No, absolutely. By the way, I just want to also tell you the other aspect, which at least the market is keeping a close eye on, is the Adani FPO. And I was just looking at the, just a little detour, but the FPO is done, the total is done about, the 40% of it is done. Let's keep an eye on that as well. The QIB portion, I mean, this is the latest which is coming through, is done some almost 70% or so. The HNI portion is done, almost 80%. And retail, of course, is still lagging. But overall, I mean, the rule says the QIB portion has to be done a full one time, and the overall issue has to be done 90%. This is excluding the anchor book. It's kind of sort of coming along. This has been an issue which has kind of plagued the market for the last couple of days. And I think with the FPO coming to a close today and the numbers starting to pick up, something which will be very keenly watched, not just for the group of stocks themselves, but for the rest of the market, banks, etc. As well. Anything else?
Okay, there's a very nice chapter called Growth Magnets in this Decade. That is 2023 to 2030. And the subheading, India is prepared to grow at its potential once the one-off shocks recede. The paragraph details very clearly that there is a very good reason to be optimistic about the coming years and the coming year for sure, because balance sheet repair is complete, both for banks and for corporates. As well, the one-off shock of COVID has receded globally. The one-off shock of, commodity inflation has also receded because now global logistics lines, supply lines are in place, and therefore that also will, global inflation will also recede. All told, therefore, this should be, and then there is the digitalization of several processes in India, the formalization of the economy which happened, COVID and GST. So all this form a very good cauldron for growth to pick up. And therefore, the optimism, the growth magnets for 23 to 30. Kaushik, okay, Shireen, you want to take forward that point?
No, Lata, I just wanted to make a point, Lata, on what we were discussing, that if indeed the recovery is complete, as the economic survey points out, then there is no reason why the government should veer away from the path of fiscal consolidation. Yes. And that's just what I wanted to make a note of. It says after peaking in FY21, fiscal deficit is on a consolidation path. The union government is on track to achieve the fiscal deficit target for FY23. Sustained revenue buoyancy is what we've seen over the last 2 years. So the government, or at least the survey, does seem to indicate that the fiscal consolidation glide path that has been projected in the budget by the Finance Minister in 2022, in Budget 2022, on track to meet those targets. But let's see if there is any deviation that the Finance Minister may resort to when she unveils the budget. But at least the survey seems to indicate that we are on the path of consolidation.
Okay. Well, with that, let me toss it to Kaushik. Kaushik, the reason for optimism in the coming years, which the survey details are perfect, would you agree with them?
Yeah, Lata, I'm happy that the survey has given an outlook up to the next 5-7 years, up to 2030. In fact, our own study shows that India will become a $7 trillion economy by 2030, and per capita income will double from where we are today by the end of the decade. Now, this has profound implications for consumption, investment, and that's why people, those who are looking at India, just not looking at India from a 1-year perspective, they're looking from 5 to 7 year perspective. And if you think of the reforms that have been announced, all the supply side reforms, whatever you call it, I mean, this you can bucket it under formalization, digitization, urbanization, and obviously to increase the manufacturing base to get more young age population jobs in that space. So incrementally, if you move in the right direction, I think you're going to get minimum 11% nominal GDP growth, not just for this year. If you just take 6% average over the next 5 to 7 years and 5% inflation, 11% nominal GDP growth. No other country will give you 11% steady state nominal GDP growth with macro stability, with RBI looking at inflation with a hawkish eye. So from that perspective, I think, there's a lot of reason to be optimistic given the long, kind of supply side reforms that have taken place with a longer term view rather than just trying to fix the problem with just throwing money at problems.
Okay. I must, point out that the survey is fairly optimistic in that first chapter, in the Outlook chapter. They actually end by saying that India's potential GDP growth can rise to 7 to 8% per annum in the medium term. I haven't heard such a positive view. 7 to 8% was what, between 2004 and 2008, when the whole world was growing at 5 to 6%. Now that's not what the IMF is expecting. Also, climate challenges are much more serious in this decade than it was in the first decade of this century. So, I mean, I'm 7 to 8% per annum in the medium term potential growth. I just want quick comments from all our three economists on that. Pranjul?
I think it's possible if we do the right reforms. We've done several, but many more still have to happen. Power sector reforms are very key. The direct tax code is very important. Continuing on improving ease of doing business. So I think if we do all of that, we can get a 7% plus growth. And quickly also to say that we have a very two sort of speed economy right now. The formal sector, giving us the growth, and the informal sector. If we find a way of new India, the formal sector, to positively spill over into the old India, which is the informal sector, and lift it up, I think there are lots of growth gains to be had. So yes, I do think it's possible.
Okay, we haven't done that in 75 years. Pranjul, I do worry we haven't created the number of formal jobs, the percentage of people who are in the EPFO or who are in the pension system or in the formal sector has not risen very significantly. I think we are still well below 20%. It's a tall ask, but we should be at least inching higher there. Okay, anyway, quick comments. We have to wind up here. Upasna, 7 to 8% in the medium term. Actually, what they're expecting is 6.5% of real GDP growth in the current year. They expect that 30 to 50 basis points to the GDP growth for the next decade will be added simply by a public digitalized infrastructure. And therefore, that's why they're pushing from the 6 to 7% growth that we are seeing in the last 2 years to a further 7 to 8 because of this public digital infrastructure delivering another 0.5% easily. Upasna, your thoughts?
Lata, the PLI scheme we are missing out, but I think that has a lot of potential going ahead. Our own estimates suggest that about 40 to 50 basis can be added to the GDP numbers annualized if PLI scheme was to be brought to its full potential. So I think around 7% is something which is very realistically possible. And of course, I would agree that there is a need for many more reforms, and more so the correct execution and timeliness of implementation. I think much of the reforms have been announced broadly. If we look at, if you just look at the logistic reforms, the recent national logistic policy that has been announced, all of this taken together holistically is extremely positive from the medium term perspective. But I would say that the timely execution would be extremely important to achieve above 7% potential growth.
Well, Upasna, Pranjul, Kaushik, many thanks for joining us here on CNBC TV 18. And once again, it's been quite a morning for us to have brought our viewers the highlights of the economic survey ahead of it being tabled in Parliament. But this is an exercise that our producers have been working on as we pour over the fine print. Just to give you a word cloud, a thought cloud of the economic survey, I'm going to leave you with that. 683 times. That's the number of times that growth has been mentioned in this over 400-page economic survey. Inflation getting a mention 356 times. COVID 169 times. Exports 153 times, and of course interest rates, etc., also making a mention. FDI being mentioned 68 times, and Ukraine 36 times. We're building out the word cloud here on what the economic survey has put together for our consumption, and of course we will get you more right here. But plenty happening in the markets, as Prashant was pointing out. The big story that we have, of course, been tracking is the Adani FPO. We will return with that right after this very short break. Many thanks to our guests for joining us today.